Alright, it's Ricardo Castillo Trades, and on this video I want to go ahead and break down my long-term stock portfolio as of February 2021. I am a stock and options trader, however I do have a long-term portfolio as of recently, so I just wanted to make this video and break down what I'm holding, why I am holding it, and my thought process behind my investments. And I will also log into my brokerage account and show you guys where I got in, what my profits and losses are, and my outlook for the future of these stocks as well. So let's get started right away. Alright, so first of all, here are my 6 long-term holdings. I am based out of Canada, so do have some Canadian holdings. I have Air Canada, ARK Invest, FinTech Innovation ETF, ARK's Genomic Revolution ETF as well, Dividend 15 Split Corp Fund, a very good food, and Vanguard's 500 Index Fund ETF. So as you can see here on the right hand side of my screen, a pie chart with all of my holdings. My biggest holding is Air Canada with about a third. Then it's VOO with about 1/4 or a quarter. Next we have the very good food stock, Dividend 15 corporate fund. And then we have the 2 ARK ETFs. ARKG and then ARKF. Alright, so I'm going to go ahead and break down these names alphabetically. So let's get started with Air Canada. Air Canada is Canada's flag carrier and largest airline. It trades on the Toronto Stock Exchange or the TSX. And what I like about this company is that it has almost like a monopoly, if you may say. Unlike in the US where we have different airlines such as Southwest, American Airlines, United Airlines, Delta Airlines, or even Alaskan Airlines, in Canada there's only really 2 airlines. There's Air Canada, which is the main airline, and then we also have WestJet, which does have a significant market share as well. But since there's only 2 options for Canadians to travel, it's unlikely, in my opinion, that Air Canada goes out of business. I think, yes, they've been having a tougher time because of the pandemic, but in terms of what the government would do to help them out, they would bail them out and not let this company go bankrupt. Before the pandemic, the stock was trading at around 45 to 50 bucks a share. And more about this position is that I sold a February 19th, 2021 25 covered call 3 weeks ago, and it actually expired today worthless. So I got to keep my full premium, and I'll break that down in a sec. Alright, so let's get started with Air Canada first. So if you look at Air Canada in a 1-year time frame, we can clearly see that before the pandemic it was trading at around 43, 44, 45, even 50s. And right when the pandemic hit, it dumped dramatically all the way down to 12 bucks. And in hindsight, yes, I wish I would have bought when it was at 12, 13, even 15 bucks. But I didn't know how long stocks were going to keep going down, and I was uncertain as to what was going to happen. But I actually got into this position right after this earnings report right here. They were expecting an EPS of negative 2.86 per share, and they reported a EPS of negative 2.31. They did lose money, but they lost less money than analysts and other people thought they would. Gapped up, and I bought in at around 19 bucks, and after that it actually went all the way up to 28 bucks. And in hindsight, yes, I wish I would have sold here and bought all the way down here, but these are my long-term holdings and I do not want to start trading my holdings, and I do not care if the price goes down or up on a day-to-day basis. I care more of a weekly or even monthly performance. And lastly, what I want to go ahead and cover is my short call option on this. And I believe on this day right here, American Airlines reported really good earnings and Air Canada gapped up because of that. I didn't think it would be likely for Air Canada to reach 25 bucks by February 19th. So I went ahead and sold the 25 covered call with an expiration of February 19th. And as you can see today, that option expired worthless. Air Canada was trading at $24 right here. Since I was short, I get to keep all the premium that I collected. So I'll go ahead and break down where I got in, where I got out. Sorry, not where I got out, where I got in and why. So you guys can see that I bought 100 shares of Air Canada at $18.97, and right now it's trading at around 24 bucks. So I do have a profit of 26%, and yes, I am up 500 bucks. However, I do not like to pay much attention to my dollar amount P&L, because as investors and as traders, we should focus more on percentage gains, because dollar amounts can be deceiving sometimes. I sold a February 19th 2021-25 covered call. It actually expired worthless today, so I do get to keep my full premium minus the commissions. So I actually only netted 30 bucks. If you look at it from a percentage point of view and the strategy behind it, so yes, as a long-term investor, I do want Air Canada to go up, but I didn't think it would go that high in such a short period of time. So I took advantage and put my shares to work by selling this covered call. Alright, so my second holding is ARK's Fintech Innovation ETF, ARKF. This is an ETF that trades on the NYSE Archipelago exchange. So ARKA, it's an actively traded ETF, and it has a 0.75 expense ratio, which is not bad in my opinion, considering that it's actively traded. This ETF primarily focuses on financial technology holdings, and it includes technologies in these areas right here. Some of the top holdings of this ETFs are stocks that I really like and I do see potential in the future, like Square, Zillow, PayPal, Pinterest, Mercado Libre, Shopify. So in my opinion, these are really strong holdings, and I do like this ETF quite a lot. This was my most recent purchase, and depending on how we see these stocks moving in the future, I may add more to my position. So let's go ahead and break down ARKF. I bought it just recently. Actually, I bought it I think at around 54 bucks, so somewhere right here, and after that it kind of dropped, and in hindsight, yes, I wish I would have bought more here, but you never know. As it went up, it could have gotten even more down, so I didn't want to add more. So this has already made a huge run, and I'm not ready to put a whole lot of my portfolio in this yet. I do see it going even higher, but I don't want to expose myself to more risk that I'm willing to take. So if we go into my brokerage account, I bought at 54.39, and right now it's at 62 bucks. So I am up 15% already, even though this was my most recent holding in the past 3 weeks. I guess it's been one of my best performing holdings. Next, we have another ARK ETF, and that's the Arconomic Revolution ETF, or ARKG. This ETF also trades on the NYSE Archipelago Exchange, or ARKA. It's also an actively traded ETF, and it has the same expense ratio as ARKF. This ETF, however, focuses more on genomics and is more into like healthcare and biology innovations. These are some of the areas that this ETF focuses on, and here are the top 10 holdings as well. And even though I don't know a whole lot about each individual company right here, I did watch some videos and read more about what genomics are, more about CRISP innovations, and I actually think it's something that's going to be really important in the future for treating diseases and for agriculture even. So I definitely suggest you guys to at least take a look at this ETF and some of the cool things that these companies are doing. If you go back here and we look for ARKG, we can see that it's also been doing really well since the start of 2020. It tripled in value since then. It was at around 33 bucks, and right now it's like at over 100. This ETF I bought in at around mid-November as well, so I think I bought some at around 74, 75, and then it rallied crazy, and I kind of messed up on this one because I did buy some more at 111, and a few days afterwards it went all the way down to like 100. So I wish I would have bought these shares here instead of here, but that's okay. I am green on this trade as well, and I am up almost 30%, I would say. My initial average price was 74, but since I added a couple shares at around 111, it did go up. All right, so let's go to the next holding, the Dividend 15 Split Corp. This is a fund by Quadravest, and it trades on the TSX as well. It's a monthly paying dividend stock, and I am invested in the Class A shares, but there's also preferred shares that trade under this ticker symbol right here. This stock pays 10 cents per share every month, and as of today, the stock price was $6.90, which makes this a dividend yield of 17.4%. That's crazy considering that other stocks provide on average about 2 to 4%. A really high dividend would be 8%. So definitely anything above 10 is like unheard of. But before you go ahead and dump all of your life savings into this fund, let me explain what they're all about and the possible risks involved with this holding. This stock has had steady dividends since 2004. I think I messed up here. I think the fund actually started in 2004. And it never missed a dividend payment except during the COVID sell-off, which of course everything dumped super crazy and whatnot. But one thing to know is that this stock is not a buy and hold stock. This stock does provide cash flow since it provides monthly dividend payments, but it does not guarantee capital appreciation. I just want to emphasize on this, and I'll break down in my next slide. These are some of the core holdings for this fund, and we see a lot of financial and insurance corporations here in Canada that are really well recognized and really good from an investment point of view. And yeah, now I'm going to go ahead and break down the FN's chart. So if we look at it from a 1 year or even like 3 years, we see that this fund has been going kind of like flat and like eventually going down. So this is what I mean, that this is not a capital appreciation stock. But the nice thing to know is that it has paid monthly dividends ever since its inception without missing a single payment, except of course during the COVID pandemic sell-off year and during the October sell-off as well. So I got into this at around $5.53. And right now it's trading at $6.92, which from a capital appreciation point of view, I am up 25%. However, this is not the reason why I bought it. I bought it because since then I've been receiving dividends which already account for 5.4%, which is pretty good considering the fact that I've only held this for 3 months. So why did I decide to buy this even though it's going down? So my way of thinking was that I would only be comfortable buying this stock anywhere below $6. And I remember during April that I was watching a YouTube video where a guy decided to buy this somewhere in here, and then it dumped right away. And after it dumped, they announced that they were not gonna pay dividends for the first time ever. So he was like, oh, all right, I'm out. I don't like this anymore. And he took the loss. But I did find this was an interesting investment to at least keep my eyes on. And later in the year, they started to go up again and the dividends were restored. But at the time that I watched it again, it was at around $7, like somewhere in here. And I was like, oh, that's way too expensive. So I decided not to look at it anymore. Months later, I saw that it was trending down, and I saw it at prices that were attractive again for me. And on October, I think they missed a dividend payment, but ever since then they bounced back as they were going up just like this. So I did get in at $5.53, as you guys can see right here. And ever since then, this has continued to go up, which I'm happy about. But most importantly, they've paid 3 dividend payments since then, which is the main reason why I decided to buy this stock. All right, so I guess the next question right now would be that if most of the fund holdings yield 2 to 4% annually, how can this fund pay shareholders over 10%? And the answer is leverage. First of all, from what I read online and from what I understand, is that they split the stock into preferred shares and equity, and then they also sell covered calls that generate monthly cash flow. Then they distribute all of this cash flow and all of this money back to investors as dividend payments. Something to keep in mind is that the leverage can be risky. High yield stocks do come with high risk as well. And the reason why I keep mentioning that this stock is not for capital appreciation is that if we compare some of the holdings that this company has, so we go ahead and TD Bank, BMO, Sun Life Financial, we can see that even though this fund's holdings go and continue to go higher, the fund itself does not increase in value as much. And that's because they do not directly track the performance of these companies. So if you decide to buy this fund, it doesn't mean that you would be buying into each of these companies. But since they provide so much dividends, they do not track the performance of those stocks. So something to remember is that if these stocks were to drop again, this fund would drop in value a lot. It's hard for me to say if I'd be comfortable buying more at $7 or around the $7. But again, I bought at $5.53. So even if this was to drop back to break even, I would be comfortable selling, and I would have at least received payments for the months that I held the stock. So I am by no means advising anyone to go ahead and buy the stock at these levels. All that I said was that I bought here, and right now it's here, plus I am receiving monthly dividends. With that being said, let's go to the next holding, and that's the Very Good Food, also known as Very. It's a BC-based plant-based meats company, and it trades on the Canadian Securities Exchange. In my opinion, this company has a huge opportunities for the future, since the plant-based diets become more mainstream and there's more buying this type of meats, and there's more consumer demand for this. Its current market cap is around $550 million, I believe, and in comparison, Beyond Meat, which is in the same industry, has a market cap of $10 billion. This doesn't mean that I think Very Good Food is going to reach $10 billion or that the share price is going to increase dramatically, but what I am saying is that if you look at other companies in the States, they have a way higher valuation, and $500 seems like a pretty good valuation as of right now, considering their financials and their possible future outcome. If we look at their chart, I will break down where I got in. So this stock IPO'd recently, and I actually bought in at around $3.99. So somewhere in here, I believe it was here. Oh no, actually it was not here. It was after the spike. I believe it was somewhere around here. Like, yes, I know that recently, a few months back actually, we reached the $9 mark, and I wish I would have sold here and bought again right here, but that's really impossible to know for sure. I am happy with my entry, and as we can see right here, I have 190 shares at $3.99, and right now it's trading at around $6.27, so that's a profit of over 50%. In hindsight, I wish I would have added more at the $4 mark. Lastly, we have the Vanguard's 500 Index Fund ETF. This is a passively managed ETF that tracks the general market, so the S&P 500 companies. It also trades on the ARKG exchange, so ARKA, and it has a really low ratio of 0.03%. If you look at SPY's expense ratio, it's 3 times higher at about 0.09%, but still, that's relatively low considering that if you were to put, I believe it was $10,000, you'd be paying $30 for management fees on VOO and $90 on SPY. So it's definitely not much given how it's going up. I don't think it's a particularly big deal. And the nice thing about this guy is that it does pay a dividend of 1.45 annually. So nothing crazy compared to my 17% stock. Actually even higher, because when I bought it, it was at around 550. So if I remember correctly, the dividend yield when I bought it is 25%. So it means that every year I'm getting 25% returns. But anyways, it does pay 1.45%. And one thing that I do want to go ahead and mention is that if you look at the VOO, we are near all-time highs, and my average price entry is $322, and right now it's traded at $358, so I am 11% in the green. So even if the overall market was to take an 11% correction, I would still be break even, and I would be perfectly okay with that, since I am holding this for the long term, and I would not be too concerned with daily or even weekly price action. I started buying this right here at about 307, I think, and then I kept buying like one a month, so that's why my average price is 322. Yeah, so this was my long-term portfolio breakdown. These are all of my holdings, and as you can see, all of my holdings right now are in the profit, which is really good. And with that being said, thank you so much guys for watching, and I will see you guys in the next video.